down a couple of its hedge funds. Actually, what was reported initially was that it's shutting down one hedge fund after it was likely to suffer losses related to exposures to First Brands, the bankruptcy, the factor firms that gave it money, and then all the allegedly fake collateral and fraudulent collateral that goes along with it. That's something, but then it was reported, because you know what happens, some media outlet gets the story, then the rest of the media start making phone calls, and you get more information. So this morning we get more information, and it's not just one hedge fund that UBS is shutting down. It is shutting down a second hedge fund that has no exposure to First Brands at all. And so that's the signal that I wanted to talk to you about today, because it's an important one, especially as it relates to the R word. And the R word, I don't mean recession here, though. That's a possibility. Well, we'll get into that in just a minute. Now, I'm going to make some comparisons to 2008. Before we get into that, too, I want to be absolutely clear. We're not saying there's going to be a rerun of 2008. What we're really talking about is, in this case, and the reason why I'm reaching back to 2008, really 2007, is that we're looking for parallels. Crisis, or even just economic downturns, or what we're seeing here in private credit and shadow banking. These are processes, and these are processes that even as time changes and the world evolves, there's a lot of the similarities with them. There's not necessarily a template, but there definitely is a pattern. As the guy once said, history doesn't repeat, but it does friggin' rhyme. And so we're looking at certain things and certain parallels. And so when we look at the parallels to 2007, I want to make clear here, I'm not saying that 2008 is happening. We're going to repeat that. There are definitely some differences here, and some differences that are in our favor. But what we're saying is, what we're seeing are signs that are consistent with that process playing out. And as I've been saying for how long now? I've been talking about repo. These are signs of escalation. So UBS shutting down these two hedge funds, especially the second hedge fund, which brings up the R word, these are critical signs of escalation. So let's get into what we have here. So give me just a second to get the information all ready to go. All right. Okay, so like I said, we got the information yesterday. It was the Financial Times that first broke it. UBS is going to liquidate the funds, though, as we say, they don't like to use the word liquidation because there's negative connotations with that. But they said, okay, there's a fund that has exposure to First Brands. They're going to liquidate it, shut it down. Makes perfect sense. I mean, you don't want to keep that sucker open. And then we get more media reports, and the one we're going to refer to here is from Bloomberg that says, okay, yeah, they're shutting down the one fund. There's exposure to First Brands. There's losses, but there's a little bit more going on to the story, and that's really the part that we're going to focus on. It brings up the R word here. The reason why they're shutting down the funds is not necessarily the losses. The reason they're shutting down these funds is because investors are saying, we want our effing money back. We weren't supposed to have losses here. We want our money back. And so they're being forced to not necessarily stand behind the fund. We don't know if that's the case just yet, like we'll see in the previous example in 2007. But either way, the O'Connor group of funds, which are in working capital finance, factoring, exactly the parts of the private credit market that we've been focusing on, now we're seeing redemption requests. That's the R word, and redemption requests is a serious, potentially really serious escalation in not just the situation, but also what it means for liquidity and the ability of the entire space to maintain as it is, to stay as it is. Because once you start getting redemption requests, that puts liquidity pressure on funds, on fund sponsors, on the entire system, maybe even on the repo market, to the point that if it doesn't resolve itself very quickly, and if it leads to more redemption requests at other funds and then systemic liquidity pressure, that's when you start getting not just funds being shut down, but as they're being shut down, they're forced to monetize their assets, which is really just a fancy word or a euphemism to avoid having to say liquidate, fire sales, distressed sales. That's what we're talking about here when we talk about the R word, and that has just shown up in these UBS funds. So continuing here with Bloomberg, what they reported late last night, I believe, or early this morning. What they said was the one fund that we're talking about, the working capital opportunistic fund, is being wound down, and the majority of the assets are going to be monetized. And again, monetized is just a euphemism to avoid saying liquidated. And they say by the end of the year, which I think is not real. I mean, I don't think there's anything nefarious about that. I think it just relates to the fact that First Brands is going through a bankruptcy, and therefore, they don't know what the bankruptcy. I mean, obviously, these funds are going to put in creditor claims. They don't know how they're going to be worked out. They don't know if there's any assets left. So what they're basically saying is we're going to wind down the rest of the fund that isn't in bankruptcy, and we're going to liquidate everything by the end of the year. So this is the parts of this one fund that really sticks out, is that only about 70% of the value do they expect to recover by the end of the year, which means that they were exposed to First Brands and the bankruptcy 30%. So this is an enormous exposure to First Brands, enormous exposure to fraudulent collateral, all of that stuff. Therefore, bankruptcy courts, lots of uncertainty, huge exposure. I mean, 30% is huge. It's a big chunk. So, I mean, for this one, you could say, okay, this one fund, they stupidly lent to First Brands. They did a lot of other investors did the same thing, but they stupidly lent to First Brands. They were way overexposed, so it makes sense they're going to shut down the funds. This fund, what's the big deal here? Even if there's redemptions, I mean, you can't blame investors for saying, you guys did something we weren't expecting you to do. You looks like you might be taking huge losses. So they're just shutting down the one fund. End of story, just another one-off, or just another one-off cockroach, right? But then buried a little ways down this article here, and there was actually reported in a couple articles too. It also said UBS is liquidating a high-grade strategy fund with no exposure to First Brands. In other words, not being tied up in the bankruptcy, not being tied up to the losses and the fraud and everything that we already know about. So either this other fund is experiencing problems, or what's really happening here is redemption requests. The redemption requests are hitting other funds and not just those that are tied directly to the cockroaches that we know about, which suggests that wealthy investors who've seeded all of these funds, who are responsible for the equity in a lot of these private credit arrangements, shadow banks, and therefore are the key behind the ability of private credit to basically exist, they're saying, okay, First Brands, this one fund, we get it, that's bad, but what else is there? Maybe we should just start redeeming our investments and ask questions later. That's the thing. That's the alarm bell. This other fund is saying, what UBS is saying is this other fund is getting redemption requests. Again, that's not confirmed, but we're reading between the lines here. This other fund is getting redemption requests that has no exposure to First Brands, which means these institutional investors are saying, we don't want any exposure to factoring credit, maybe even private credit, and maybe even going beyond that. So that's the key here. That's what we're really focused on. Not just the one fund, but the second fund and what it suggests about the willingness of these key investors to stick around and see how this all works out. And by the way, the term high-grade strategy, we all laugh about it, high-grade strategy, they experience huge losses. That isn't just a marketing label. That is a technical term, and that's the one we're going to continue to see as we go through the 2007 example. High-grade strategy means something specific, and again, something technical. These are investments that are supposed to be high-grade, and what that means is usually, if we're talking about asset-backed securitizations, these senior pieces. And so that tells you something important too. There's not supposed to be any losses in high-grade because they're senior, they're supposed to be protected, but if investors are redeeming them or they're trying to get redemptions in some of these funds that are supposed to be high grade, whether they're exposed to First Brands or not, it tells you that there's a lot of investors out there who are likely starting to get cold feet about more than just the cockroaches that we know. Like I said, it's about maybe the entire space, maybe private credit overall, not really willing to stick around and see how everything works out with all of the questions surrounding the entire private credit marketplace. You see what other cockroaches pop up. And really, do you want to stick around in a fund, whether they call it high grade or not, whether it's invested in the senior tranches of securitizations or not? Do you really want to stick around in a fund to find out how many other cockroaches are coming out, but also waiting to see how everyone else reacts to it? This is one of those cases. This is one of those signals where when people start to think, I should just make sure I get to the exit before everybody else does, that's a significant sign of escalation. Like I said, our focus here is on the process. And this is an important sign in that process on unfortunately going in the wrong direction. So high grade, not supposed to be losses, not just a marketing term, there's something specific there. So let's go back to 2007. If you remember anything about the 2008 crisis, it really began in 2006. And it really got to be serious in early 2007. In fact, the Bear Stearns hedge funds and the losses that they were starting to take was one of the earliest warning signs that this thing was getting seriously. In fact, it was one of the episodes that precipitated Ben Bernanke going in front of Congress in March of 2007 and saying subprime is contained. Bear Stearns had these two hedge funds. One of them they just set up the year before, but Bear Stearns by the middle of 2007. So this is even before August of 2007, before the real crisis finally broke out. Like I said, these things are a process, and this was one of the warning signs that said this thing is escalating, getting increasingly serious. When you started to see hedge funds, and you started to see, well, everything that we just talked about with these UBS funds, except for some key differences about why this is taking place, and differences in terms of scale, as well as what particular parts of the credit markets we're talking about. Back then, it was banks and their sponsored SIVs. Here, we're talking about shadow banks and credits, and not really sure about how much exposure is to banks. But the process is very similar. It has a lot to do with the R word and cold feet. So back in June of 2007, so a couple months before the real breakdown in August, well, 6 weeks before the August 9th breakdown in the marketplace, you had Bear Stearns that said, look, we've got some hedge funds. They suffered some losses. We're going to buy out the one fund just because we don't want there to be, a spreading risk, especially to other banks that have lent money to the funds. And that's another thing we didn't talk about with UBS, how much bank exposures there are funding the funds of funds and all those kinds of other things. But either way, Bear Stearns' shocking announcement, and by the way, $3.2 billion back then, huge amount. I mean, everybody was comparing that to LTCM, which was, a decade before then. And LTCM was, monster thing. LTCM was less than what we're talking about here with these Bear Stearns hedge funds, which had everybody really buzzing at that point, especially since there was a second fund involved that was even larger. And the reason why Bear Stearns felt it had to step in was because of redemptions. So for the couple months up until June of 2007, the fund kept on reporting a little bit of losses and a little bit more losses and a little bit more losses. And finally, investors said, we've had enough of this. Start giving us our money back, or at least start giving us as much money back as we can possibly get. And it just kept escalating and escalating and escalating, not just with the Bear Stearns funds, but the entire hedge fund space, the entire subprime mortgage space, and then the mortgage space entirely. As more and more investors got cold feet, as more and more hedge funds were hit with redemptions, that led to more and more strain on the system. More banks had to step in, more strains in repo. Fire sales took place, stress liquidations. As I talked about in yesterday's deep dive analysis at Eurodollar University, there was an instance where Merrill Lynch had to step in and seize collateral and found that they had no buyers for the collateral. So the redemptions here, the R word, again, suggests a serious amount of escalation as it did back in 2007. So once you started getting those redemptions, you have a couple of choices. Either the fund sponsor can step in and make everyone whole to try to maintain or try to limit and contain the damage, or they can have to start monetizing their assets and get whatever price that they can, which means in an illiquid market or an increasingly illiquid market, distressed sales at lower prices, meaning greater losses, which leads to that vicious cycle of distressed sales, lower prices, less collateral value, less liquidity, distressed sale, lower prices, and on it goes. And again, just like in UBS's funds here, the Bear Stearns funds, both of them that we're talking about, high grade, not a marketing slogan. This meant that the structured credit, tells you right in the name, high-grade structured credit meant that these Bear Stearns funds were invested in senior and super senior tranches of mortgage bond securities and mortgage, MBS securitizations. But it also meant because you're in these high-grade parts of the securitized structure, on their face, nominally, they have lower levels of returns because they're safer. That's just how basic finance works, which means they were also, in order to make these worthwhile to institutional investors or wealthy investors or hedge fund investors overall, they have to be highly leveraged, which brings in the repo market, because repo is where all that leverage comes from, with these assets in these securitization structures as the collateral. So you have this high-grade set of assets that attracts all of these investors who are told these are high-grade assets, therefore very low credit risk, which is absolutely true, but they never really tell you about the liquidity risk. And once the liquidity situation starts to turn in the wrong direction, that's where the losses actually come from, not necessarily the credit risk. And we'll get into that a little bit here, though I did a YouTube video on this a little while ago. But it wasn't just the one fund. The other fund was also high grade structured credit. Same thing. Supposed to be credit risk, very low, very minimal credit risk, which was true. But in the situation that we're seeing with redemptions in hedge funds, low liquidity, repo problems, repo providers, and leverage providers overall, increasingly unwilling to fund some of these structures, regardless of whether or not they're money good, it leads to that vicious cycle that I just talked about. In a lot of ways, that vicious cycle gets kicked off when these institutional hedge fund investors start getting cold feet and start demanding their money back, which means these hedge funds themselves are not able to continue to fund their positions. There's your sales, and there's the bigger problems. And again, when you're advertised high grade, from the perspective of institutional investors or just hedge fund investors, wealthy investors, when you're advertised high grade, you're thinking there's no possibility of losses. And of course, that's what they tell you. So when you start getting losses, you can't really blame people for saying, we want to start redeeming I don't care what give us our money back today. Monetize the damn thing. What do I care about? I need to get back as much as I can because, and this is the other part why I want to bring up 2007, the lack of information, the opacity, the information asymmetry that really, really worked against us in 2007. And in many ways, which is why we use the term shadow banks, it's also a major problem here in 2025. We don't have information. We're not getting information. As the Bank of England's governor said, Andrew Bailey, when he investigated and started asking questions about private credit in the UK, he came out and told Parliament he's been given the runaround by private credit providers. He knows they're blowing smoke up his arse because it's plain common sense. That level of information asymmetry really works against us because then investors who are seeing those guys over there are asking for their money back from the hedge fund and they're taking losses, and yes, maybe it's a one-off with First Brands, but then they're taking, they're asking for their money back in another hedge fund that has to do with factor credit. Nobody's giving us a whole lot of answers. It becomes one of those things where you say, redeem my investment today, ask questions later. You get to the point where you don't care about information anymore because you're not getting information that you need to say, okay, that's just a one-off thing. I'm just gonna sit tight and not worry about it too much with my own investments. So the lack of information, this information asymmetry, really does work against us in these systemic periods where you don't have a lot of information, but you can see there is something to be concerned about. And that something to be concerned about is escalating to a point where it is actually creating losses. You don't care where those losses are coming from the perspective of individual investors. You could not possibly care less. All you're seeing is that there's losses over there. This is in an area that's questionable to begin with. We all know there's stupid stuff there. There's losses being taken. And now we know that other investors are saying, give us our money back, give us our money back. This is the avenue for contagion. And it starts with the R word and redemption. So like I said, the UBS, not necessarily the first fund, but talking about the second fund that's being shut down, no exposure to First Brands, suggests that we're getting to maybe the initial stage of that next step in the process where redemptions are creating the bigger escalation. Maybe it's a crisis, maybe it's not a crisis, whatever this thing is going to work out to be, that's what we're getting here. This is an important step toward that direction. And again, it was the same thing with Bear Stearns in 2007. Long before you got to June, problems started to show up. Not just with investors asking for their money back, but then you get Wall Street firms, leverage providers, liquidity providers that start asking for either their money back or better collateral. Because they realize, like I said, with Merrill Lynch went through a really troubling episode. It was one of the episodes that was maybe the biggest spark that lit the actual crisis in August of 2007. Merrill Lynch, like I said, seized collateral, found no takers for the collateral, and basically was stuck with assets that they couldn't sell, which is the worst case scenario when you're a collateralized lender. You're supposed to have dependable collateral that you can liquidate at a moment's notice and get all of your money back. So you get to this escalating situation. Investors are asking for their money back. They're redeeming stuff. Wall Street leverage and liquidity providers are asking for either their money back or better collateral. But as we know in these situations, there isn't money, there isn't collateral, there isn't dependable markets and liquid markets available to sell assets to be able to monetize everything in a way that that makes everybody happy. the stresses start to build. They start to build with hedge funds. They start to build in repo with collateral. This should start to sound familiar here. So that's what we're seeing, and that's what we're looking for in this process building toward what looks to be a pretty serious development here. Like I said, I did a YouTube video about specifically what happened in 2007 as far as what was causing the depressed values in some of these high-grade assets. And it wasn't credit risk. It wasn't losses. I know subprime mortgages are treated and talked about as toxic waste, but a lot of those things were never, there was never any credit losses. It was all about illiquidity. And so I talked about what that was in the YouTube video not long ago that relates to the most critical variable in all of, not just structured finance, all of finance, especially modern finance, correlation. And talked about how important that is to valuing these senior pieces and really how little margin there is for them because just because I don't need to get into it here, but because senior pieces do have some risk related to pricing and liquidity, something called a correlation smile, which you can see here, which is an actual one from 2006. But what the trigger was back then was liquidity in the mortgage market led to revaluations of even senior pieces of securitization. Now, we don't have that problem here. We're not talking about mortgages. In fact, that's the good news in all of this. The reason why we're not making a comparison to 2008 is because we don't have the same scale. We don't have a mortgage credit problem, which is basically the vast majority of financing credit anyway. So we don't have that level of difficulty here. However, that said, everything that we see about private credit and shadow banking and bank exposures to private credit and shadow banking suggests that while we're not talking about a 2008 level of downturn or obliteration of the entire world, we're not talking about a huge crash, a monster crash that takes out everything. We are talking about significant enough money that it's going to be painful if it continues to move and continues to escalate. So while not necessarily 2008, that doesn't mean we're in the clear here. In fact, it looks like there's going to be a tremendous amount of pain that comes along with it if it continues to escalate in this manner. So in 2007, 2008, what was triggering the high-grade asset losses was correlation among mortgage bonds and really the illiquidity credit default swaps. I don't need to get into all this stuff, but it's stuff related to housing. In 2025, what we're talking about here, part of it is fraud, which is the common thing that we keep getting in all of these collateral cases, whether it's Tricolor, First Brands, what are the other ones? There's so many, Zions and Western Alliance. The one we didn't see it was PrimaLend, but PrimaLend had collateral problems too related to something else that Steve and I are going to talk about this weekend in the car business. So there's always a collateral thing in there, but we're not talking about housing market here. Instead, it all comes back to, in this case, jobs. That's why I keep pointing to the macroeconomic situation in the labor market, and I keep using the term flat beverage, because flat beverage is everything here. All of the stupidity in these private credit markets relates to giving firms or individual borrowers credit based on the idea the labor market was solid, the economy's in good shape, Jay Powell knows what he's talking about. Take all that stuff away, start to see layoffs come from Challenger Gray and Christmas at the level that they did in October, suddenly those assumptions, the idea that private credit is nothing like what subprime mortgages were, a generation ago, that gets thrown out the window. And so the worse the macroeconomic situation, especially the US labor market, looks to be, it's not even about the actual pricing or credit risk, it's about perceptions, especially when you throw in there that investors are already redeeming their fund positions. They're already getting cold feet. Then you start to see job losses and weak labor market statistics come out all over the place. It raises the level of itchy trigger finger. It makes them even itchier. It makes people want to just go for the exits regardless. Just give me my money back. I don't care what it is. Just give me what you can give me back today. The more we see macroeconomic degradation, the more it's going to lead to problems over here in the private credit markets and funding them in hedge funds and redemptions and liquidity and leverage providers and everything else that we saw in 2007 heading into 2008. And just one final point I want to make here. Actually, two final points. One is we haven't seen, ever since the last week in the big Volatility in repo markets, illiquidity in repo markets leading to the huge spike in activity at the Fed's repo window. Not surprised that this week we've seen everything calm down. In fact, I actually wrote about it in our deep dive analysis on Monday. I said, look, we expect the repo situation to calm down in the short run now that we got through the month end. That was what was weird, and I mentioned this before, about the huge surge in repo activity and then the volatility, huge spike in SOFR rates last week. Was it last week? No, October 31st. At the end of the month. We usually didn't see those at the end of the month. They're at the beginning of the month, not the end. So that was unusual to begin with. But either way, not surprised that the repo situation has calmed down. SOFR rates have come back down below the Fed funds upper limit. In fact, this last check, I think SOFR was 390-ish, somewhere around there. Not actually that far from federal funds rate. That is not abnormal. That's not unexpected. Like I said, we expect the repo market situation to calm down in the short run, even though we have all of this other stuff going on in the background with UBS shutting down hedge funds, suggesting that there's a strong escalation there. Because even when you go back to 2007, before August 9th of 2007, same types of things that we got here. The Bear Stearns hedge fund saga began really around, you started hearing things in February 2007, then it got to March, and then Ben Bernanke said subprime was contained. And just look at how the money markets behaved in that period, that preliminary period preceding the clean break and the real start of the crisis in August of 2007. So you had the Bear Stearns bailing out hedge funds, you've got Merrill Lynch seizing collateral in June and July of 2007, and you look at money markets and they look relatively placid and stable. One of the reasons why Ben Bernanke says subprime was contained is because he said, look, money markets seem to be okay. Yeah, we hear some market disruptions. We don't like what's going on in some of the ABX indexes and credit default swaps, but overall things seem to be relatively good. But this is what I'm talking about, the process that takes place behind the scenes, in the shadows, under the surface, whatever euphemism you want to use. You can see these escalations they're taking place under the surface, and they start to get worse and worse and worse until the point that they actually break out. What I'm saying is I think that we've seen already some of this spill out because of the nature of what we're talking about here, but it's not, in the context of what we're seeing in the repo market this week, it's not abnormal to see money market rates start to calm down, even though we've got something what looks like a pretty significant piece of evidence that things are moving in the wrong direction and escalating. So we've got high-grade hedge funds, once again, not one, but two of them. And the second of those is not even related to the First Brands bankruptcy, which tells us in a small scale right now, the series of escalations we're talking about, a small step in that direction, at the very least, investors are saying, we don't care that it's not exposed to First Brands. We don't care that there's not losses that you're going to tell us about. We don't care that we only have this group of cockroaches that has revealed itself. What we're saying is we don't want to be exposed to the business overall. Give us our money back before something bad happens. And if they're doing that at UBS, chances are there's a lot of phone calls taking place all across the private credit land, hedge funds and everything else saying, what do you got there? At the very least, people are making investigatory phone calls, trying to get more information that we know they're not going to get. But the fact that we're seeing redemptions, the fact that we're seeing, again, a fund that is not experiencing losses, that is significant. Now, we don't know exactly what it means moving forward, but it fits with where we've been going up to this point. And remember our long run picture here. The long run picture that was given to us by the swap market years ago was that in the language of interest rates, rates are going to go down. Say it with me, they're going to go down by a lot, and they're going to stay there a long time. Now, we aren't there yet. We still don't know exactly we get there, but this fits, and it fits only too well. So I wanted to bring it to your attention. A couple of really serious pieces of news here. Don't want to get too overexcited about it. It is very serious. It's something to be concerned about. Doesn't mean the end of the world. Doesn't mean we're repeating 2008. What it does mean is that we need to pay close attention to what's going on here. And if you're one who is predisposed to look at the stock market and say, oh, stock market's fine, none of this could take place. Remember, the stock market was hitting all-time highs in October of 2007 anyway, completely ignoring what was going on in the shadows at the same time. So we need to be careful of what's going on. We need to be on our game. We need to be talking about everything. We need to be examining as much information and details as we can possibly get. So I want to make sure everybody had this UBS information and what it actually meant, because it is, in my opinion, a very significant development. So hope everyone has a great rest of your Friday and a great weekend. Anything else that comes up, I'll make sure I let you know what's going on. See you all again very soon.